In today's video, I want to talk about one of the most important metrics in startup finance, the burn rate. And we'll see how to calculate and manage it properly. Welcome back to my channel. My name is Roland Umlauf, and I have been working as a startup CFO advisor and consultant for, about nearly 2 decades now. Well, let's talk about burn rate. Why are your investors asking about it, and why should you care? Well, about nearly 30% of all startups fail because they simply run out of cash. Let's start by talking terminology. Well, there is gross burn and then there is net burn. Gross burn basically is your total monthly cash outflow. So this is, your ongoing cost, your payroll, your Amazon web bills, your rent, if you actually have an office, etc. It's basically what you spend each month to keep the lights on. On the other hand, net burn is your net cash outflow. So it's basically your gross burn minus your monthly revenue. So imagine you're spending 100K and, let's say you're getting 40K from your clients in revenue. Your net burn will end up being the difference, 60K. So when an investor asks for your burn, that's really the number that they're looking for. And this is an important number because net burn is what comes out of your bank account each month. So how to calculate this number properly? I know it's a simple formula, but still, people get this wrong all the time. First of all, don't use your profit and loss statement. Use your cash flow statement when you calculate. You want to look at, cash used in operating activities. You don't want some adjusted P&L number. Also, do not include your financing activities in your burn calculation. If you've just raised $2 million in your last round, that's not income, that's a capital injection. Your operations, they're still burning cash during the month of your raise. You just have a bigger bank balance now. So burn is really about the operational efficiency. It's not about fundraising success. Burn calculations also can get misleading when your income is, fluctuating a lot. Many companies have clients who pay for, a whole year up front. So imagine in January, your cash flow spikes, and in February, it looks like you're going out of business because you have no income at all. Well, in practice, I would recommend one of two things if you have this situation. So either you look at a 3 to 6 month rolling average instead of looking at a single month number. So you average your burn over, let's say, the last quarter to smooth out this variance, and hopefully you'll see, the true trend. Now, this doesn't always work, and it can also distort your true rate if you're growing, either cost or revenue at a really fast pace. So the second way of dealing with this is instead of using your actual monthly income, use your current MRR for the calculation. You know your MRR number. So you're normalizing annual payments by using the MRR number, or you can directly just normalize annual payments by, assuming that you're receiving it in monthly chunks instead of a one-time payment. And this will give you a normalized net burn that reflects the business model and not just your seasonal invoicing trend. Well, also recently, investors have started using, a different metric on top of this called the burn multiple. This is also interesting. The burn multiple measures how many dollars you burn to generate $1 of new annual recurring revenue, or ARR. So the way to calculate this is you're taking your net burn and you're dividing it by the net new ARR generated during that month. As an average Series A startup, you should sit somewhere around, let's say a times 1.6. Well, maybe if you're a new AI native startup, this can even be low times, 1. If you're above X2, you will likely have problems going into fundraising. If we have a burn rate, how do I analyze burn rate? Well, the first thing we can calculate is what's called the runway. So that is basically our current cash balance divided by the monthly burn rate. This gives us an idea of how long we have until we run out of cash. The next calculation that I like to do is if you would stop hiring today and you just maintain your current cost base, as well as your current revenue growth rate, would you actually become cash positive before you run out of money? This is an interesting calculation because especially if market conditions for fundraising, can go adverse, this is a great metric to keep an eye on in order to manage your cost growth sustainably. Okay, let's take a look at how these calculations would work in practice. So I've prepared a very simplified cash flow statement here for some fictitious company. We see this is a SaaS company. They have some MRR numbers here, and they are getting paid by their clients. Some clients pay monthly, and other clients pay an annual fee. So their cash flow, the amount of money that comes in every month, is not, it's very volatile. So we have some months with 40K, some months with 100K, etc. In terms of their cost, they have about 95K in salaries, some other operating costs which are fluctuating quite a lot month over month, and then also they are making some VAT payments at the end of each quarter, for the previous quarter income. Additionally, they've raised some money recently, so we have a round of 800,000 in April. In January 25, they raised some bank debt, 150K, which they then repaid in May 25. So there's a bit of financing cash flow here. Again, this is just purely simplified illustrative example. We have their bank balance down here. And we're calculating the change on the bank balance month over month. Now, I have seen startups that literally take this change of the bank balance and report that as their cash burn number. Again, I wouldn't necessarily think this is a great number, especially because it includes all this financing cash flow. So, here we're burning 87K. The next month you're having, 765K plus. This is not a, operating cash burn. This is, money that has come in from your equity round. So you should not be reporting this way. Now, let's take a look at how we actually can do this. And I'm going to show you 4 different ways of calculating your cash burn. So we're talking about net burn here. First one, I'm just going to take actuals. So in this case, what we're going to do is we're going to take the amount of money that's come into our bank as payments from customers, and we're going to subtract our operating cost, and we're also going to subtract these VAT payments because the amount of money that comes in, that includes the VAT. So we take this here and we can calculate this forward. Now, if we look at this number, this is a classical net burn number here. We would go from minus 87 to minus 35, minus 23, minus 86, and so forth. So we see that there is a lot of volatility, which doesn't make this a very stable KPI in this case, and it doesn't necessarily give us a lot of information about how this company is performing in the long run. Again, this can be useful in some circumstances, especially if your cost base is a little bit more steady, and also, if you're just getting these monthly payments from your customers, for example, then, this will give you a really, really good number. But in our case, not so much. So let's try the other 2 or the other 3 ways of calculating. The next one I'm going to show you is a 3-month rolling average. So what we're going to do is we're going to take the average of customer payments minus the average of all this cost and including the VAT payments that we're making to the tax authority. And we're going to divide that by 3. So we're getting a bit of a smooth out cash burn. And let's take a look here. This still remains a little volatile, but it's significantly better than the previous line. So we see that, 40, 50K, 60K, but, it doesn't jump around as much as line 22 does. Now, I also told you that we could use, instead of this operating income, so when we're looking at what's actually being paid into our bank account, what we can do alternatively is take a look at MRR. So I'm going to use MRR as my income number, and I'm going to subtract cost from it. And in this, here I need to be careful because I don't want to subtract the VAT payments anymore, because the MRR number is net of VAT. So this is really just your revenue number. Okay, so we're taking this month over month. Let's take a look. And again, this is not a bad statistic at all to have. So we're seeing that, due to the volatility of our other operating costs, we do have a volatility in our burn, and that is, perfectly fine. Now, we can stop here and, use this parameter, especially, we don't really know where this volatility in the other operating costs comes from, if this is, something seasonal, if this is discretionary spend. Why do we have this variability? Maybe we're having to pay something annually, etc. But if we want to have a more robust indicator that does not have this volatility, and we want to use that, to measure our long-term performance and predict our long-term performance, we can smooth this out again. And what we're going to do is we're going to use the MRR number, and we're going to make a rolling average here as well. So what I'm going to do is I'm basically taking 3 months of MRR, and then I'm subtracting my costs for 3 months, right? Again, we're not using the VAT here, and we're dividing by 3. And we're getting a average indicator based on our MRR and average cost. And we see that now we're having, 37, 48, 57, 69, 63. This tends to hold relatively steady. This is seems to me to be a much better indicator of, cash burn over time than any of the previous 3. So my favorite is this, line 25. Next, what we're going to do is we're going to calculate our runway, and we're going to use, again, all 3 cash burn numbers. So what we're doing is we're basically taking our bank balance and we're dividing that by cash burn. Let's just take out the minus sign here. And we're getting runway in months. Okay, so all of them basically give us an idea that we have about 6 months left in our bank, which is not good. Let's take a look at how they behave over time. Now, what I said about, volatility of these, it's one thing to, have the cash burn for, a specific month, etc. That's fine. But if you use that number to calculate runway, then depending if you've adjusted it with a rolling window or not, you're going to, get runway estimates that, jump wildly from, 3 months to 26 months. That is not a useful statistic here for me. Again, as I said, I do like very much this line 30. Also, line 28 is not performing badly at all. So we see that, we have 4 to 6 months left basically in runway, using the rolling average just based on actual customer payments. Next, let's calculate the burn multiple. So the burn multiple, I've already done this. The way this works is you would take the current burn, and I'm using my preferred line 25, so MRR and rolling average cash burn number, and we're dividing that by the new ARR created for the month. Now, how do we calculate a new ARR? We're basically taking our MRR number from January, we're subtracting December, so that gives me a difference of 2,000, and we're multiplying that by 12. So we're having 24,000 in additional ARR. right? So we're having 37,000 cash flow divided by 24,000 new ARR created, which gives us 1.57 or 1.6 as a burn multiple. So we're not in a bad situation here, right? Now, what we can see also is, we're kind of down to, 6 months, 5-6 months cash runway here. But what I said earlier in the video is also I like to do an analysis where I'm basically simulating, if we keep doing what we're doing, what's the end game, right? Do we run out of money, or are we actually able, or should we be able to, get to an operating equilibrium with a steady, where our income basically exceeds our cost base. So let's do that simulation real quick. What I'm doing is first I'm calculating the average growth rate for MRR over the last year. So I'm saying, okay, from January 25, we've grown from 55,000 MRR to 90,000 MRR. So we're basically calculating a monthly growth rate in percent for that, which is 4.18 percent growth per month. And the other thing I'm doing is I'm taking the average operating costs over the entire year. So we're spending about 134 and change per month to keep the lights on. So next, what I'm doing is I'm basically projecting out my MRR using this growth rate. So we're starting here at 90,600 with a 4% growth rate. We should have 94,390, etc. So we're getting a MRR growth over time, and then my cost projection, I'm just using the average cost here, and then we're using our bank balance. So we're using previous bank balance, and we're basically assuming that these things happen as income and cost, and we're projecting that forward. We're seeing that we're actually about to run out of money here in November, but in December 26, we're actually starting to generate net cash. So what am I seeing here is, if we keep doing what we're doing, we do have a path to break even in this case. But this company is, starting to be a little bit low on cash, even though they have 230,000 in the bank. So what they should do is, maybe try and, shave off some of that discretionary spend in the other operating costs if it does not necessarily have a big impact on growth. Obviously, if this is, marketing spend or customer acquisition cost, then, that obviously needs to happen, but they need to definitely be cost conscious, but I wouldn't rule out a path to profitability here. Obviously, if their cost was a little bit higher, then we can see that, this already starts to be a bit of a problem. Well, I hope you found this interesting. Let me know in the comments if you have any questions about burn rate, and please subscribe to my channel for more content on startup finance.